just a bit of a recap, sort of get our minds back into thinking about what we're doing in this module, get the brains working. So a bit of a review. Okay, so what we did last semester. First part, you looked at the various different methods of valuation. We'll have a little sort of quick romp through those in a minute or two. We spent a lot of time on the concept of discounting, the idea that money in the future is seen as less valuable at today's point in time. That concept of discounting is very, very important when we're doing valuations. We did some discounted cash flows, an essence of how investment valuations are carried out, and we looked at the valuation tables. We looked at three elements of them, three parts of the table in some detail. We looked at some of the others, and we'll, again, just have a bit of review of those. Okay, so remember when we were looking at the basic investment calculations, we have this relationship between the rent of a property, a yield that is applied to that property, and what produces the capital value. And in theory, if you know the two of the elements of that triangle, you will be able to calculate the third. So if you know that a property has sold for a capital sum of money, and you know what the rent is, you're going to be able to calculate the yield. And it goes with in the other respects. If you know the other two, you can get to the third one. So, for an example, and to get your brains working, to get your chance to get your calculators out, or if not, your phones, we have an example here where a property has sold for £120,000. We know that is the capital value of the property. We're being told here that the rent is £6,000 per annum. So, as I said, if we've got two bits of the equation, we can find the third. So can you please put your get your calculators working and tell me what the yield would be in this case? Okay, have most of you got answers for this one? It's a very simple one. But it's important that you understand this relationship, because this is the essence of investment valuations, and being able to adapt and use these bits of information very quickly is quite important. So basically the answer, the £6,000 divided by, so that's the rent, divided by the capital figure of £120,000, it comes up with a figure of 0.05, you times it by 100 to find 5%. So, okay. So it's basic mathematics. You've got to be able to perform and understand how these work very quickly. What we can do when we've got these pieces of information, we can either use the information to obtain a valuation, or we can use the information to analyse a valuation, a transaction. So, if we know the rent, we know the yield from a property, we can work out how much the property is worth. We can carry out a valuation. Or, if, as in the last case, that example where you just worked out, where we've got a sale price, we know what the rent is, we can analyse that information, and therefore we can find out, in the example, what the yield is. And we can then use that information for other transactions, for other valuations. So it's been able to play with figures, analyse them, and use them in another scenario. Okay, but about the basic methods of valuation. We've mainly focused this last semester on the investment method of valuation. Investment method being the idea that you own property as an investment, you have a tenant, an occupier of a property. That's bringing in some rent, some money. What is that investment worth? That you have no occupation of the property, all you have is the right to the rent, and how much would you pay for that asset? The comparative method is very much that it's quite an introductory type of method, and it's very much used for very simple valuations. If you are valuing a house, residential property is the classic example. They're usually houses can be quite comparable. They can be very similar in characteristics. If you've got the sale of one transaction, you can apply that sale, probably analysing, probably making various adjustments. You can apply that data to value other properties. It doesn't have to be just residential though. It may be farmland or it may be office blocks if there is sufficient uniformity between all the blocks. So if you know there's a number of transactions on a development of office blocks and they've all sold for a price and they are directly comparable, then you can just apply that data straight away and put it to your property. And there's always an element of the comparative method that you're using all the other valuations. So when you're looking at the rents for properties, you're looking at what are the comparables, what's the comparable rents for the properties. When you're looking at yields, what are the comparable yields? So you're using the evidence to make your decisions and to carry out your valuations. Okay, residual valuation. This, remember, is a methodology, and in fact, it uses some of the comparative method, it uses some of the investment method. And the idea is, it's almost a hypothetical situation. And it's used for a development appraisal, usually on a development appraisal. So thinking, well, if I had a piece of land and I built a office block, some houses, some retail units, what would it be worth in the future? And it might be worth, say, £5 million. Well, what's the cost that I have to incur to get to that development, to complete that development? I've got to buy the land, I've got to put the structures onto the land, I've got to get planning permission, I've got to use professional advisors. So I've got my hypothetical future value, I take away my costs, and I am left with a sum of money. And that is the residual method of valuation. You will probably do a lot more with that in next year, but just so you're aware of it. The profits method of valuation is a methodology. Okay, give me some examples. Where would you use a profits method of valuation? Yeah. A pub, great example. Lovely. Anything else? It says here where the business is carried on the premises. Is carried on, or gives the premises a premium value. So the premises is the transaction, what's happening in the building is a business and it's creating income. So we've got a pub as one example. Let's get a few more examples out. Yes, it does essentially, but it's not usually valued on a comparable basis, mainly because it's not the trade of shop is not essential to that unit, and because they pay a very, very clear rent. There is a clear marketplace with retail units, so they usually just are done on an investment or a straight comparative basis. I can understand where you're coming from, but it is a subtle distinction. Something else? Nightclub, yeah. So very similar to a pub. You're getting receipts in, you're getting people trading and getting that receipts in. Anything else? Yeah. Fast food shop, a bit like the retail units, this is the distinction between them. Fast food shops will usually be sort of in a retail unit, and as such there is sufficient comparable rental evidence that they're done on an investment basis. But it's very similar when they talk about getting receipts in. It's such as pubs, nightclubs, hotels, marinas, anything where there's not necessarily a lot of comparables, and there is something quite unique about the building that can bring in a certain amount of trade. It's not comparable one unit with another.